Hello, ladies and gentlemen. Welcome to Teens and Money, the teen guide to growing your money. I'm Tony Byer, financial wellness coordinator, here with you this evening. Also, with us, we have Holly Salima. She is our youth marketing specialist. Woo! And we are also joined by Derek Hartlip. He is our manager of our Altra financial advisors, and he'll be able to answer some of the questions that we have about investments here and really making our money grow. And we want to send, yes, applause to Derek, but also applause to each and every one of you here as well. We'll just keep that going while I have the sound effects up. So as we're going through this, if you have questions, feel free to put those in the chat, interact with that. I'll do my best to stick, to keep up with that, but also Holly will be able to help us through all of this as well. And if you miss any of this, we are recording it, so it's going to be available on our YouTube channel. Check that out and tell your friends and things like that. And stay on, because at the end here, we are going to be drawing for the Amazon gift card. So thank you, each and every one of you being here today. So what we're going to talk about in our brief time together, that is just some financial basics here. So managing our own money, what we need to know as far as spending plans, building savings, why all of this is important, these lifelong skills that we are going to be using the rest of our lives. We'll talk about, again, some of the investments, things to think about in the future here as well. So some of those basics, things to keep in mind in building, wealth in the future. Never too early to start thinking about some of this stuff. Why it's important to diversify your investments. So basically that means a lot of different eggs in a lot of different baskets. We'll talk about the role risk plays when it comes to insurance and understanding that. But taking advantage of compound interest through savings. So the money that we put into savings or other, we call them deposit products in the biz, but basically different savings accounts and things like that, earning that extra free money. Take advantage of that. And who wants to be a millionaire? I know I do. I want to be like a 13,000-aire. I think that sounds pretty good. So when it comes to, the future, talking about big money, feel free to put in the chat. What are some big? Let's have everybody. We're fast forwarding way into the future. Each and every one of us. We are years down the road. We're independent. We're on our own. What are some big, costly things that we're going to have in the future that we're more than likely going to have to save up money for? So feel free to put some of those in the chat. Things that we're thinking about when we're independent on our own. What are some costly things that's going to take some time when it comes to savings and things like that? So a car, a home, things like that. Yeah, we've got the estate right there. Not too bad. Travel, if we want to do that, starting, a family, our future education, all those different things. So very good. We've got some chats in there. Excellent. Here. So that's the future. Those are, silver appliances. Why not? So that's the future. But when it comes to spending our money, right now, what are some things that we're spending our money on currently here? So if you get money, whether that be through a job, whether that be through birthdays, holidays, allowance, things like that, what are some things that we're spending our money on now? Yeah, food, clothes, gifts. Yeah, if you want to get gifts, we got to give gifts. That's just a nice thing to do. Very good. Awesome. Yeah, so if we have a vehicle, if you buy the vehicle, you're not done spending money on it. So like we said, car payment, a lot of other costs go with it. Insurance, gas, maintenance, all those things. So with a lot of purchases we make, we got to think about, all those things that go with it as well. Carrie's saying fast food. Yeah, I don't skip any meals with that. So those are some of the things that we're spending on. We've got those needs. So again, the automobile, like we mentioned, clothing here as well. So, what we're wearing casually, if you're in any sport, some of that gear could be costly. If we're working, there may be a certain uniform or a way we have to dress. And of course, hopefully we're wearing our shoes more than once as well, because those are pretty costly. We've got our entertainment needs, concerts, video games, electronics, cell phone apps, things like that, music and movies. And of course, I couldn't forget food as well. So This question was actually asked by The Atlantic a few years ago to 14 to 18-year-olds, so teenagers, how they are spending their money. And they came back with this beautiful, beautiful monochromatic graph. And they found that the two biggest categories of spending were clothing and food. I don't know if that surprises anyone. It doesn't surprise me. Young adults tend to live like we're on the Oregon Trail. We care what's on our back and what's in our belly because we may not have quite all of these costs yet. Some of us may have more of these than others here, but we've got our shoes, car, electronics, music, movies, video games, books. I would love to find the 2%, a 17-year-old spending nice money on a credenza or something of that nature. But there is something missing from this list. And experts say we should putting at least 10%, at least a dime out of every dollar toward this. And we should look into doing that right away. Feel free to put that in the chat, what you think it might be. So something that is missing right there. And Carrie's got it. Ding, ding, ding. Yes, that is savings. Save, 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 save. Very good. We should do that right away. Because if we wait to put money into savings, we're probably not going to have that 10%, probably little, if anything. There's always too much month at the end of the money. But save, 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 save. Do it right away. And it's going to be a phrase that I'm going to repeat more than likely a few times with this. It is pay yourself first. So make that a priority. Can't stress that enough. And so on the next slide here, I'm going to introduce you to a couple of friends of mine. They're not real, like most of my friends. Brad and Jenny. So Brad gets started saving earlier, and then he stops. But Jenny, she gets off to a later start, but she saves more money. We'll see who has more money in retirement, Brad or Jenny.
What is compound interest? Compound interest means earning interest on your interest. It's essentially free money. Let's take a look at the power of compound interest. Meet Brad. Brad started saving money when he was 18 years old. He saved $2,000 a year for 16 years and then stopped. This means Brad put a total of $32,000 of his own money into his investment account. From there, he decided to let the money sit and not add any more to it. Now let's meet Jenny. Jenny didn't start saving money until age 34. She also saved $2,000 a year. However, unlike Brad, she continued to save every year through age 65, for a total contribution of $64,000 of her own money into her investment account. During this time, both Brad and Jenny earned a 5% annual return. Now let's fast forward to age 65. Whose investment do you think is worth more? Brad, with his total of $32,000 invested over 16 years, or Jenny, who invested $64,000 over 32 years?
All right, so I will say both Brad and Jenny look great for 65. I hope I look half as good as Jenny when I'm her age. So Brad, at age 18, he saves $2,000 a year. He does that for 16 years, and then he stops. But he doesn't touch the money. That's the important part. Jenny, she gets off to a later start, but she saves twice as much over twice as long of a period. So feel free in the chat. Put down who you think is going to have more in retirement. Is it Brad because he started earlier, or is it Jenny because she put more in? Or is this a trick question of both of them? They're going to have exactly the same 50-50. You could put both Brad and Jenny. T-Bone is trying to play a trick on you. I'm T-Bone. So there we go. We got a mix here going. So who will have more money? And they're getting 5% each and every year on their money. So taking advantage of compound interest. All right. So we've got a mix of some saying Brad, some saying Jenny. Let's see how they did.
Over time, compound interest accelerates your savings. Believe it or not, Brad came out ahead, over $78,000 ahead. Starting early is key. Brad put less money in, but started 16 years earlier. Since he invested earlier, the interest kicked in sooner. It turned his $32,000 into over $236,000, and he didn't have to do a thing.
Yeah, I don't know about you guys, but I'm pretty good at doing nothing. In fact, I've been told that more often in my life than I would really like to hear. But Brad, again, he only put in $32,000, but he made more than $200,000 in free money. Jenny did pretty well for herself. She made more than $94,000 in interest. Now, if Jenny was to keep putting in money well into her 200s, she would start to approach where Brad's at. I don't know if she's going to make it that long. She looks great for 65. And again, I know these are cartoon characters and they're not real. But really, the big takeaway here is to start early, start often. And with each and every one of you, here in the webinar, time is on your side. If you're young, start now. Just imagine you're younger than 18 and you're already putting money away, how much you can have in the future. So we're teaching how to get rich. Slowly, but get rich. So talked a little bit about a budget and spending plans, but I've not defined it yet. So a budget comes from the French word bouger, which means to rain down rapid fire. I'm just kidding. I made that up. It's what it is. It's an itemized summary of likely income and expenses for a given period. It's money coming in, money going out, simply put. So if we are spending more than what we have coming in, we're in debt and we're not able to do what we want with our money because we have to repay that debt. If we've got a surplus of money, hey, that's a great problem to have. That gives us options. That lets us, achieve, some of those goals and things that we want to do here in the future. So how it can help us is just knowing where and how our money is spent. We work hard for our money. We want it to work hard for us. And if we've never done this before, as far as keeping a spending journal or tracking our spending, it could be really eye opening. Those little things, they can add up very, very quickly. We want to make sure bills are taken care of. Hopefully, as teenagers, you don't have too many bills yet, but you're going to have bills in the future. And I don't want to lie to you about that. So making sure those are taken care of. Preparing for what you never see coming. I can virtually guarantee each and every one of you in the future that there's going to be an instance, more than likely multiple instances, where you're going to have to fork over a bunch of money and you never saw it coming. You never know what's going to happen, with your health, your career, your living situation, those you depend on, those that depend on you. Transportation needs, appliances, you just never know. So, you can go ahead and ask, parents, guardian, grandparents, aunts, uncles, dogs, cats. They've probably experienced it. I know that I have, and I'm sure that on the call here as well, Holly and Derek have experienced the same. So experts say we should have at least 3 months of living expenses saved up in an account that we can access easily, something that would be in a savings account, something that we would call liquid, something that could easily be turned into cash. Because we'll talk about investments in the future, and sometimes trying to take money out of an investment, it may not always be quick, and potentially there could be fees or things like that take away from it. So if you've got let's say a pipe has burst, or what happened in our house, walked out of the basement and we've got inches of water because the bottom of the water heater just decided to, give out. You needed money and you needed yesterday for a plumber. Yeah. Could not get here soon enough. And plumbers, expensive, very much so. So having that emergency fund really, really, really helps. Makes it easier to save money when we have a plan for our money. We're a bit better able to achieve goals. So maybe we're thinking about, a vehicle of the future. Maybe we want to do some traveling. We're thinking about our future education, perhaps starting a business. Who knows? That's going to be more achievable if we've got a plan for our money to accomplish those things. Goal setting and having a plan really go hand in hand. And then peace of mind as well. Money troubles can affect all areas of a person's life. So if we're having trouble, keeping the lights on, keeping the water running, keeping up with bills and things like that, it can make it, really difficult to concentrate on work, or, it causes stress and strain with, families, friends, relationships, even internal stress as well. So having a plan can really help with all of these things. And I'm so glad we're learning about this now because, like I said, it's a lifelong skill. So we want to track the steps real quick. We want to track our spending. We got to know what we're working with. So income coming in, and then how are we spending our money? And do we want to make any changes? Every transaction, every penny. If we could do that, that's awesome. But I think that might be just a little bit tedious. I say have a really good idea of where your money's going. Taking a look at, maybe how you spent it, let's say in your checking or, transaction account or spend account, let's say, but, having a good idea of how we're spending our money really, really is going to help you out. What's important to us needs to be in your spending plan. So there are needs that we're going to have, as far as, our clothing, food, things like that. And as we get older, we're going to have more needs and more likely more people, dependent on us and things like that. But also what's important to you. If we like looking good, if we like the nice wardrobe, awesome. Make sure that's a part of your plan. I think I need to update that picture. I'm pretty sure it's from 1997. It was a fashion bug. But make sure that's a part of your plan. And that way, if you spend money on clothing, you stay within your plan. You don't have to feel guilty spending money on it because it was all in your plan. If we like going to concerts where there's, breathing fire on stage, I don't know. I don't judge. That's fine. Make sure that's part of your plan. We want to be rolling down the street in the convertible with our hands out the window going, money ain't a thing. Woo! Make sure that's a part of your plan. And as our situations change, our circumstances change, our lives change, our spending plan is going to change as well. It is not a set it, forget it type thing whatsoever. It is very dynamic. So that means it's always going to be changing. So when it comes to putting money into savings, I really recommend once we start earning a regular income, we start working, if you're able to set up direct deposit, awesome. Definitely do that. That way your paycheck is automatically put right into your transaction account, your checking account, that spend account like we talked about. And you can have a portion of that go directly into savings. Automation can be a wonderful, beautiful thing. And when it comes to putting money into savings, if you don't touch that money grows as well. So any automatic, do that, but pay yourself first. Again, make that a priority. Can't stress that enough. Really recommend using a system that works for you. So what works for one person may not work for another. If we want to curtail our spending, we want to get that a little bit more under control, let's say, a popular method is using cash. With that, there's the envelope method. Is what that's called. So we could get a bunch or all of our paycheck in cash, and then you physically assign it to a different envelope. So you've got a different envelope for every major category of spending. So in the example that we see there on the screen, we've got an envelope for groceries. We've got another for clothing, car repair, for a future vehicle, emergency fund, maybe going out to eat. But if our going out to eat envelope is empty, we've spent it all already. Do we keep going out to eat? No. You can't steal from other envelopes. The whole system breaks down. A good friend of mine, he's done a system like this since he was in college. And so it really works for him, helps him visualize his money, assign it a job basically. But I know it wouldn't work for me because for whatever reason, I get a little cash in my pocket gets warm and I got to spend it. I'm a lot better with a debit card, with a credit card. But I know that doesn't work for everyone as well. There's also, if you're a very visual person, the calendar method as well. So that is, let's say you get paid on these Fridays, so you know what you've got coming in. That you have bills due, these upcoming weeks, and can give you a good macro view of your month and really help you visualize your cash flow and not forget about any bills. As well, it can help us avoid the payday debt cycle, like we'll see here in just a moment here. But it really helps to do it, before the next month starts. So September is going to be here before we know it. So taking a look, how have we spent our money? Let's say here in August, or we can even look into July as well to get a little bit more of an average, and that can help us set our next spending plan. There's a lot of different tools and resources and things. We've got a great budget visualizer and everything. Just kind of a breakdown of how we spent our money in our mobile banking. But spreadsheets, you can get QuickBooks and stuff if you really want to get to it. But I really recommend, if we haven't done this before or if it's been quite some time, pen and paper. works great. Go real basic. So we've got our income. So we've got to know what we're working with. We could write this whole big, huge budget, but if it's not in line with our income, all that time was wasted. So we've got our paycheck. We got birthday money from grandma because let's face it, we are her favorite grandchild. So we add all that income together. And next we have our expenses. So we're putting money into savings. We're buying food, clothing, gasoline for our car. We've got to pay for car insurance. We've got a music subscription, easy for me to say. Grandma's got a birthday coming up, so if you want to get gifts, we have to give gifts. We're going to the water park. Why not? Enjoy the last, the last ray of summer. And this budget hasn't aged too well. We still have a fidget spinner on here for $528. Do you guys remember those? I don't either. So we add all our expenses together, subtract it from our income. And we've got $444 left over, that we can put into savings or do what we like. So the more basic your budget, the more likely you are to stick to it. So I really recommend, do something basic and then figuring out what's going to work for you from there. So I mentioned the payday debt cycle, something we definitely want to avoid. This is definitely something that has happened to me in the past. I teach a lot about this and go into a lot of classrooms, work with our members and those that are young at heart. And I'm not perfect with any of this either. So no judgment whatsoever. But let's say we get paid. Let's say we get paid today. Why not? On a Tuesday. That's just fun.
Morning, cha-ching.
Yes. We're feeling so great, in fact. We are digging back into the 90s, the 1990s, and we're playing some NSYNC. Stop that song. I don't have the rights to it, so they might be litigious. I don't know. But we're treating ourselves. We got food at home, but you know what? We're going out to eat. And payday wasn't all that long ago, and the next payday is quite some ways away. So we're like, okay, hold on. I got to be responsible. Hold up. But then we see a nice pair of shoes. Oh, yeah, we got to get those shoes. Yeah, they're nice. And then we're pulling out our pockets and going, oh, no, I got these bills due. Uh-oh. And next payday, that is far away. Grabbing change out of the couch, change jar, stuff like that. And we just make it to the next payday. What if something unexpected happens? We'll have to rely on credit or borrow money or just not pay those bills. So we want to avoid that. Absolutely. So that's some information on, managing our own money, doing that. Now we want to seamlessly transition into talking about investments, helping our money grow with that. But really the foundation of all of this, that is going to be to manage our own money here, because we're not able to do the investments if we don't have something in savings or things like that, or being able to do that. But again, things to think about here in the future. So we'll talk about, and like I said, we've got Derek Hartlip. He is our manager for our Altra financial advisors. So those that work with our members and help them with, their different investments and talk about their goals and helping them with retirement and protecting their money. So he manages our advisors. So we'll talk about what you can find at your financial institution, things that we offer at Altra. We'll also talk about bonds as well. Another type of investment are mutual funds as well. We'll talk about what those are and why that's important. When we talk about investments, probably something that comes to mind for most, it's going to be stocks. It's going to be, being a shareholder. The more stock we have, the more, ownership that we have of a company. Real estate can be another type of investment. Typically, owning land or buildings or things like that. Like a lot of that, what we say, it appreciates in value, so it becomes more valuable typically over time, and they're not making more land as well. Precious metals, commodities that could potentially be traded, things like that. Annuities, an insurance product. Pokemon cards, who knows? So what we'll focus on for our time here today are going to be the top four. So what you find at your financial institution, bonds, mutual funds, and also stocks as well here. And In no way, shape, or form am I telling you what to do with your money because I am not certified. But like I said, we've got Derek here to answer more of your questions that you have here as well. So what you could find at your financial institution, definitely going to have savings accounts. So putting money in there, your money is safe, it's protected, guaranteed to be there up to $250,000. And then also your money can earn money as well. That's that compound interest that we saw Brad and Jenny were earning that really helped their money grow. It helped Brad's money grow over the course of just shy of 50 years. Now you get money, from savings accounts because you're letting that financial institution use a portion of your money. So like we saw before, we got money from our grandmother because we are her favorite grandchild, like we said. And let's say we put that grandma money into our savings account. Now that money in the savings account, that bank, that credit union, they might use a portion of that money, and that might go into an auto loan for another member. That might go into a mortgage, so a home loan, maybe a line of credit, commercial loan or something of that nature. And for you letting that financial institution use a portion of your money, they give you money, and all you have to do with that money is just let it sit, let it grow. Checking accounts are also something else. So, many of our checking accounts, spend accounts, transaction accounts, we could think about them as, they also earn dividends as well. So a little bit extra money with those as well. Money market accounts are something else. That's another savings type product as well. So the potential to earn more in dividends, looking at the market, and it's going to be for, typically larger amounts, with those type of accounts. Also, if you've got money that that you're not going to need for a little while, consider a certificate, or at a bank, they call them a CD. But what that does, it's a savings account that locks your money up for a certain amount of time, however long the certificate is. And because that financial institution knows that money's not going anywhere for a while, they actually give you, higher interest percentage. So, all you have to do is just let that sit there, let that grow. So consider the youth certificates that we have, that graduation certificate, that matures on an 18th birthday. So turn 18, boom, and that certificate, you're able to take money, not only what you put into it, but also those dividends, that extra money that came with it as well. So definitely something to consider there. And again, making sure the financial institution is insured. We are through the National Credit Union Administration, that's shared liability fund. So accounts are insured up to $250,000. No matter what happens, that money is guaranteed to be there. No one's lost a penny through that insurance. We've learned a lot since the Great Depression. And banks, you'll find FDIC all over their commercials and buildings and things like that. That stands for the Federal Deposit Insurance Corporation. Also insures accounts up to $250,000. So making sure financial institution is insured, really, really important. So how you grow money in savings, there's three factors that do it. So the amount saved. So the more money you have saved, the more we're going to have in the future. The next thing is going to be the interest rate. So the higher that interest rate, the larger that number, that's going to help your money grow as well. And the most important thing, and so glad we're learning more about this now, especially all of you being young, and something that we saw Brad take advantage of in our video, and that is time. The longer that money sits in an account that earns interest, the more we're going to have in the future, that free money. Let that interest build upon the previous interest. So that's why even though Brad, he quit putting money in his account, he didn't touch that money or the interest that it made or accrued during that time. And that's how he was able to get that money. And just imagine if he kept putting money in there more than the 16 years, he would have even more in interest as well. So these are the three factors, and time is on your side. So save. Something I wish I'd have done a lot more of when I was younger. I didn't get serious about saving until my late 20s, early 30s. And by then, I'd missed out on years. My money could have grown via compound interest. I could try to put more in now, but I'll probably still never have as much as I would have had I started sooner. So save, 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 save. Not always, not easy, but it is important. So with investments, they carry risk as well. So understanding that is really important. And a very, very general rule is that if an investment or something of that nature, the higher the risk, the higher the potential reward. So it could potentially do well. It could potentially make you, more money, but there's also a good chance that we might lose money as well. So understanding that, and then as if an investment is lower in risk, there's potentially not as much of a reward, but more likely we're not going to lose money or potentially lose all that much. So something that we just looked at, as far as savings accounts, things like that, that's very low risk. But we're not earning a whole lot, but we're not losing anything either. And an important step with investments and thinking about this is to determine how comfortable you are with risk. So for some, some may be incredibly uncomfortable with risk. They just want everything very, very steady, don't want the potential to potentially lose any money whatsoever, save every penny and don't even want to take a chance. Or we could have the exact opposite and just like, I'm putting all my money on red, spin the wheel, let's see what happens. Don't do that. That's not a sound investment strategy whatsoever. So understanding that is really important, and a very, very general rule, very general. Again, not telling you to do with your money. While you're young, while those that are young and invest, they may be able to take on more risk potentially. Don't have to, just because there's a longer time frame, a time horizon, may say. Let's say, when it comes to retirement, somebody in their 20s. Retirement, that is decades and decades away. That's way down the road. So they may be able to take on more risk earlier because they have a longer time where if there are, dips in the market, if there are things that happen, they've got time to potentially make that up as well. Someone that's nearing retirement or maybe in retirement and they need that money in retirement, that's going to be how they live because they're not working any longer or working all that much. Typically, they're going to it's advised, or I'm not advising anybody whatsoever. Derek and his crew do that. They may lower their risk with that as well, but it's really how comfortable you are. But understanding there's risk in all of this. So something that's considered typically not as risky are going to be bonds. So if someone's investing in a bond, they're putting money towards it. That money is going to be locked up in that bond for a period of time, and we could kind of think about it as an IOU with this. So let's say we purchase treasury bonds, government bonds with this. So that's going to be over the course of quite some time. Basically, Uncle Sam and Aunt Samantha, they say, okay, you give us this money. And then once this bond matures, which could be years down the road, decades perhaps, we're going to give you your money back plus interest with this. Companies can do this, can do it as well. But a lot of times they're considered fairly safe. But again, there's still risk with all of this as well. And also something to know about bonds is that they have an inverse relationship, meaning they have an opposite relationship with what's going on with interest rates, things that are set by the Federal Reserve as well. So if interest rates, and that plays a role in financial institutions like Altra, the interest as far as loans and things like that. If interest rates go down, the value of bonds that were at an earlier interest rate, those are more favorable. Those are more desirable by investors. And if interest rates rise, bonds that were issued at a lower interest rate previously, they're not going to be as desirable, or people aren't going to want them as much because they're going to want the bonds that are issued at a higher interest rate. So understand they have a inverse relationship, meaning kind of an opposite relationship. They react with one another as well. So that's bonds. Something that's also, and we'll talk about diversification in a moment, but mutual funds as well. So they pool investors' savings. And what they are a lot of different pieces, a lot of different, stocks and different investment types, all wrapped into one fund. And they're managed by a fund manager, and there are tons and tons and tons of them out there. And they are, for the most part, diversified. We'll talk about what that means, but basically you can think about it as a lot of different eggs, a lot of different baskets. And this is a very common way in which Americans, invest in stocks and bonds and things like that. It's going to be through mutual funds. So that's what those are. And there's many different types out there as well, but it's a lot of different pieces of a lot of different companies, bonds and cash and large cap, small cap, all the caps and everything you could think of with those. But that's mutual funds. So it's a lot of different things all built into one investment fund. And when it comes to investments, probably something that comes to mind are going to be stocks. So when you put money, you purchase a stock, you have a share of it, you are a shareholder, and you become one of the owners of a particular company. And a company can issue, hundreds or thousands of stocks, or so a lot, depending on the company as well. And whether you make or lose money, it depends on the success of the company, the type of stock it is, what industry they're in, what's going on in the market, news, earnings reports, so many factors all go into it. And I'm sure we've seen like we have there on the screen, the different bar charts, the reds and the greens, and what this has done in the last day, what it's done in the last 30 days, what's it done in the last 10 minutes. Some stocks are pretty, fairly steady. Some jump around a whole lot. House of Pain. So, yeah, a lot goes into it, and some are, like I mentioned, very steady. Some are more volatile, meaning there's a lot more ups and downs with them. They can be purchased and sold through brokerage firms, discount brokers, and like I said, our Altra financial advisors, very, very knowledgeable and are able to help as well. They are not guaranteed. They do definitely involve risk, but there are some companies that actually, if they are doing well, they make a profit. So their expenses are less than their revenue. So that is that profit equation. They may actually, reward their shareholders with a dividend as well. Or some companies with that profit, they may, invest that into the company or their people or things like that. So every company is a little bit different how they may do that. But when it comes to making money, understand that those that are wealthy, they typically own some sort of stock. It's some more than others with that, but that's typically a part of their what we would call a portfolio. So all the different investment types that they have, all under themselves. If we look at the last 100 years of the stock market, stocks have increased 10% at that annual rate of return here. So if you look at the whole 100 years with that, so there have been times where the stock market has done very, very well. There are times when it has definitely gone down as well. But if we look at just the whole macro view, the last 100 years, about 10% compounded, and that exceeds any other type of investments over that period of time, that long here as well. So knowing that, again, it does involve risk. Understand and know that. So I've mentioned diversification a couple times, especially when it came to the mutual funds. But it's a good idea to invest in different types of companies, different industries. So we're not putting all of our money, we're not putting all of our money in, soft drinks or something like that. We're mixing it up. I want to go in this direction, or agriculture, or this, so a lot of different companies, a lot of different industries. We want to mix things around, because if we have all of our money into one company and that company does well, awesome. That's really going to help. That's really, really risky. If that company goes down, yeah, we're going down with it here. So that's why we want to put a lot of, good way to put it, different eggs, different baskets. So if we've got investments spread around and one industry does, one company does terrible and another does pretty well, we still end up kind of around the middle, and we're not absorbing those big shocks in the system as well. So it can help lessen our risk as well, lower that risk. And again, eggs and baskets, that's probably the easiest way that I like to think about it here. But again, not a professional whatsoever. So don't put all your eggs in one basket. I'm sure we've all heard that in one way, shape, or form, but it's definitely true when it comes to our investments. A lot of different eggs, a lot of different baskets. And something to consider in the future. So a retirement account. So with this, so if you're working, at least 18, can potentially open up a Roth IRA. And what you put into it, it's with after-tax money. So that means the income that it's already been taxed by Uncle Sam and Aunt Samantha. They've already grabbed their little bit out of it. And so when you withdraw it, the minimum age it's going to be 59 and a half. You don't have to worry about taxes with that, because it's already been taxed previously with that. And in 2026, those with a Roth IRA, the retirement account, they can contribute up to $7,500. They're under the age of 50. It's an additional $1,000 over 50. They call a catch-up. They're not like Heinz ketchup, like you're able to catch up a little bit. Yeah. And you can't contribute more of your income than you have. If you've only made, let's say, $4,000 through a summer job or something like that, you can't contribute more than what you've made with that, if that makes sense. So our Altra financial advisors could definitely help with this. Other institutions could do that as well, but that's something to think about as well, to consider. But probably one of the best investments that you can make is in yourself. So I know this number is a little bit old, 2015. That's the last official number that I've seen from the government. But this still very much rings true. The more education that we have, the higher potential earnings that we can have over our lifetime. And these are just a yearly salary. And just looking at, what's the middle of that? So just by graduating high school, that gives us almost a $10,000 bump when it comes to our work, our salary. Some, an associate's degree, some college, or even a bachelor's degree, that's really going to help. And then any advanced degrees, so potentially a master's degree or professional degree or designation with that doctorate, perhaps. But also, the more education that we have, the less likely we are to be unemployed. So still able to earn an income as well. So that's incredibly important with this. So like I said, our invest in ourselves and our education, whatever your plans are, never stop learning. I can't stress that enough. And also wear sunscreen as well. I can't stress. I'm dishing out life advice. Yeah, skin cancer, no joke. But I know many of you are probably interested in being a millionaire. So some characteristics of millionaires. They live below their means. I mean, they don't spend more than what they have. They live in modest homes. They drive used cars, drive cars for a long time, shop at stores that offer a good value. So a lot of these people that have wealth, they may not show it. People may not really know it, and that's how they're able to become millionaires and stay millionaires as well. And this was something. It's an older book, I do admit, but talks about this, The Millionaire Next Door. So the authors initially tried to find. They went into these ultra wealthy, gated, communities, and they're trying to figure out like, okay, what makes these people different than everybody else? What are they doing differently? And what they found is there are people in those that they didn't necessarily have this wealth. They're living on credit. This is all for show. And they found that there was actually a lot more millionaires, a lot more people with a lot more wealth that lived in just, very simple, modest homes and, drove a used car or drove a car that's, 10, 15 years old and things like that. So, finding out like, oh, okay, so a lot of these people with some high wealth, just looking at them and looking at what they have, may not even know that as well, and they have that discipline not to just go out and flaunt it and spend it. They keep that generational wealth going by investing not only in their own financial planning and their own education and never stop learning, but also their children's as well. And they spend that time, like we said, on financial planning here. So pay yourself first. I said I was going to say it a few times with this, but pay yourself first. Just like any other bill, right away, your future self will really thank you. What goals do you have? So never, start thinking about things that you'd like to do in the future and how can we make that possible? Have a plan for your money and do the best you can to stick with it. If you get off track, that happens. Life happens. Give yourself some grace and do what we can to get back on track. We didn't talk too much about credit. Really, it could be a very valuable tool. It can help us, get big ticket items, spread out payments over time, more likely to be approved, for loans. It can help with, in the future, we might want to rent an apartment. Landlord, more likely going to check your credit. Insurance as well. Employment as well. They checked my credit when I applied for a job at Altra, and eventually, because if I had credit problems, if I had money troubles, and I work at a financial institution around money, yeah, that could make a potential employee really nervous as well. If we use it to, live beyond our means, we're making late payments, let's say, our cards are maxed out, we've spent all the way up to the limit, maybe even past it, that could do a lot of damage in a very short period of time. So have the plan, manage your money first, be comfortable with that. Plan carefully with all this, think ahead. If you're able to automate your bills and spending and saving, awesome. Do that. Automation is a great, wonderful thing. Be flexible with your plans. Life's gonna, change. Your plans need to change with it. Have a good idea of where your money's going. So taking a look at, past statements or how we spent our money in the past, and then any changes we want to make in the future. And then use a system that works for you, something that you're actually going to use as well. And what you're doing today is really going to help you out in the future. And like I said, a lot of this we're talking about, these are life skills. These are going to be skills that you're going to be using the rest of your lives here. So I know that I thank you, Derek and Holly, for tending to the chat here as I was going on. But want to cede the floor. For our experts here and talk a little bit more about your questions here and make sure those get answered. So again, appreciate everybody's attention. And again, as we're going through this, if you got more questions, feel free to add those in the chat.
Hey there, Tony. I'll add a couple points here now that you're wrapped up. Just want to say good evening, everyone. I hope everyone's enjoying the presentation so far. One thing I wanted to relate back that Tony had mentioned earlier about with automating payments for different bills and things like that. When it comes to investments, I always suggest doing the same thing. When you have the money to do any sort of investing, automate it, set it and forget it, and then just kind of let it be. When it comes to investing, sometimes the worst thing you can do is pay too much attention to it as well, because then you'll be looking too closely at things and thinking, oh boy, I need to get out of the market right now. And you pull your money, but then you don't realize is after the dip comes a new wave that'll carry to new highs. So I always just recommend making sure leave things in an investment and just kind of ignore the news and any sort of like dips in the market and just keep riding it and it'll keep growing. In terms of opening an investment account, that's a great question. I will say with our brokerage firm here at Altra that we use through the platforms we have available, to open up an account in your own name, you do have to be 18 years old in order to do that. One way to possibly work around that would be to work with a parent in order or open what's called an UTMA account. And what that really is just a kind of jargon for investments for account that's managed by an adult on behalf of someone who's under the age of 18. So that'd be one option where if you wanted to really get started early, you could look into those options, but otherwise opening it directly in your name. Unfortunately, you have to wait until you're 18 to open your own type of brokerage investment account. But if you wanted to look into uh, spell the name of the account for my parents to open it up. Yeah, so UTMA, I'll just put in the chat, UTMA, UTMA. So even I forget what that really stands for, but it's just a fancy term for account that's managed by an adult on behalf of a minor. So that's what that would refer to. In regards to something related to higher yield returns, you could always look at CDs like Tony had mentioned on the credit union side, where they'd offer a little bit more return than your traditional savings account. Again, you got to kind of put those funds away for a longer period. You can do, I think, Ultra offers anything for CDs from 6 months all the way up to 3 years. So you could look at those options as well. So just always keep your options open. Again, automate things, set it and forget it. I think that both works for paying bills and also investments. So that's kind of my 2 cents today. So return it to any other questions anyone might have. Otherwise, I'll hand it back over to Tony here.
Awesome. Thank you so much. It's excellent advice. Excellent advice there. And thinking about, like you mentioned, being in it for the long haul with this as well. But again, I'm not telling you to do with your money whatsoever. Not qualified here. So if there's any other questions, feel free to put those in the chat. But really appreciate everybody being here this evening to learn just a little bit more about managing our own money and just thinking about what we could do, in the future and understanding some of those ways in which our money can grow through investments here. We really appreciate everybody being here this evening. Thank you so much. We'll hang around just for a moment to answer any questions that you might have, but we hope everybody has a great, fantastic Tuesday evening. And thank you so much, and be on the lookout for our next webinar as well.